President Jose Barroso says G8 must ensure there is no going back on those commitments. Commodities are down the most since March, and the stock markets around the world are getting battered by concerns of slowing growth, rising inflation, and concerns of more subprime losses. Let's check in on how the next guest is reacting. Aaron Smith is the managing director of Superfund Financial Singapore. Superfund is an absolute return managed futures fund, and it's outperformed the MSCI World and Bloomberg commodity indexes over the past 10 years. So, Aaron, let's start with commodities. Do you see a commodities bubble? George Soros is warning of a bubble in oil, and Mark Farber is saying commodities may fall the second half of the year.
Good morning, Kathy. Actually, no, I don't think that there's a major risk of a bubble. I think if you look at history, over the past 100 years, the market cycles have been 18 to 20 years for bull markets and for bear markets. The last major phase started in 1980 till 2000. Where there was a huge financial expansion based on credit and based on other people's money. Actually, we know that there's no such thing as a free lunch in the financial markets, and actually now we're starting to pay for some of the excesses that we saw in the 80s and 90s. Therefore, we believe that the commodity bull market can go ahead at least for the next 15 to 20 years.
And how is that changing your asset allocation? Because I know the super funds got 55% invested in financial futures with about 45% in commodity futures.
Well, it's not necessarily affecting our asset allocation. I mean, we're keeping the same strategy that we've had over the long run over the past 12 years. We say that we should never change a winning team. So we have a broad diversification between energies, metals, agricultural products, grains, on the commodity side, but also on the financial futures, we're trading stock indices, interest rates, and foreign currency pairs. This is quite important because there are also strong trends on the financial side. Obviously, this year we saw a big correction or downtrend in equity indices, which we've been able to take advantage of with short positions. One of the biggest advantages of being in managed futures is it's a very robust trading strategy. We're able to take long positions if there are uptrends in the overall markets, short positions if there are downtrends, and actually if there's no trend in the market, then we can actually stay out of the market altogether.
Okay, so within the commodities that you mentioned, where are you long, short, and neutral on?
Well, in the past month, we've been long and taken advantage of crude oil, corn, various grain markets. Soy has had a nice uptrend, but we're also quite bullish in the long run on gold. In 2005, our founder, Christian Baja, was calling for $1,000 an ounce for gold. Today, we believe that gold can achieve at least $1,500 per ounce in the medium term. In the long run, we think it can actually go much higher because of the prevailing weakness in the U.S. dollar. There's a lot of fundamental reasons for this. If you look since 1971, the U.S. dollar has lost 85% of its purchasing power. So actually, it's not the best place to preserve your capital over the long run. And we believe fundamentally we're shifting into a period where real assets like commodities are more valued than paper assets like stocks, bonds, and the paper currencies.
Is it just going to be the dollar weakness that's going to prop up gold prices? Because some of the critics say there is no fundamental tightness driving the gold market with jewelry demand very weak and mining supply relatively stable.
Well, it's not only the weakness in the dollar. I think it's also the pervasive inflation that we see worldwide. I think that the government inflation figures that we see are probably a little bit too optimistic, and that we expect, at least throughout Asia and most of the world, to see double-digit inflation. We don't think that this is a short-term situation. We think that this will be sort of a theme going forward. And this is also why gold is actually a perfect hedge against inflation in the long run, to protect your assets and to protect your purchasing power. So we found that investors are increasingly looking at alternative assets like managed futures together with commodities like gold as a great inflation hedge over the long run.
Great. Good to talk to you. Thanks for that, Aaron. Aaron Smith of Superfund Financial Singapore. And after the break, a look at how the Japanese car industry is coping with surging fuel prices. A Credit Suisse auto analyst joins us.